Good day, friends. In the subject of financial markets and institutions, in my previous lecture, I talked about introduction to financial system. And while talking about the introduction to financial system, I was talking about the components of the financial system or the structure of the financial system. And one of the important component of the financial system or the structure in the structure of the financial system is the financial institutions, in which we talked about the banking system, the non-banking system, the non-banking institutions, the banking institutions, commercial banks, private banks, foreign banks, right? UTI, LIC means insurance companies, non-banking finance companies, and what role these financial institutions plays. The other important component of the financial system is the financial markets. When we talk of the financial markets, basically we have in our mind the stock exchanges, the commodity exchanges, the exchanges where the foreign exchange is being dealt. Traditionally in India, a very large component of the financial markets used to be in the unorganized sectors, the money lenders, the traders, who used to lend money to the people who needs money, right? And they used to take accept deposits even from the people, and they use their own money for lending purposes and used to charge very hefty interest on that amount which they used to lend. But over a period of time in India, these financial markets have become more organized, right? In these organized markets, there are standard regulations, norms that are being framed by the financial regulators. If I talk of the banking system, I can talk of the RBI, right? If I talk about the stock markets, means capital market, I can talk of the SEBI. So means regulators regulates these markets. That is, the markets are the important component of the financial system. So broadly, these markets can be classified, financial markets can be classified in two categories, the money market and the capital market. To start with, I will say money market is that market where short-term money is being dealt. Means money for a short period of time is being exchanged, means being invested and being borrowed. And the capital market is a market where long-term money is being dealt. Means people do invest for a very long period of time. Borrowers take money for a long period of time, right? So this is basic distinction between money market and the capital market. Let's understand what money market is. Money market is a market for short-term funds which are dealt in the monetary assets whose maturity period is up to 1 year. Friends, there is no hard and fast line where we can say where the short-term money is being dealt, which is the period for the long-term, which is the period of short-term. But normally when we generalize it, we say in a market where the money is being exchanged for less than a year is a short-term money, right? Is a market which is called money market. It may be overnight requirement of funds, and there are various institutions, there are various agencies, regulated agencies which provides overnight funds just for a day or so, or 2 days, 3 days, right? And it may be for 6 months, 7 months, 8 months. There are various instruments. I'll be talking these instruments like commercial bills, commercial papers, where for 3 months, 6 months, the money is being exchanged. When I say money is being exchanged means the lenders give the money for 2 months, 3 months, 6 months, and the borrower takes the money for 2 months, 3 months, 6 months, like that. So this market is highly liquid and considered less risky. Why it is called less risky? Because money is being lended for a very short period of time. The lender knows what is the credit money worthiness of the borrower, and within a short span of time, normally the credit worthiness doesn't changes very frequently, right? So that's why we call it less risky and highly liquid. Highly liquid in the sense the turnover of the money is very high, right? So you lend money for 3 days, you lend the money for 7 days, you lend the money for 6 months, 3 months. Just that way the turnover is very high. So that's why we call it that it is highly liquid. It's a market for short-term financial assets that are close substitutes of money. See, वैसे close substitutes of money. What is money basically? Money is perfectly liquid, which we call it in form of cash or in form of bank money, where your money is deposited in the bank. Any time you can use it, any time you can withdraw it. So, and how fast and how quickly you can convert an asset into cash or into bank money form, right? That is called a very liquid money. So these money market instruments are quite liquid because they are being converted into bank money or the simple cash in a very quick time frame, right? So the instruments in this market are treasury bills, commercial papers, commercial bills, certificate of deposits. At this point of time, since this is only the introductory lecture of the financial system, so I am not going into detail of these various instruments. When I will be talking of money market, because money market itself is a complete subject, is a complete, topic to be discussed. So when I will be talking of money market in my lectures which will be followed, so at that point of time, I will be talking about these instruments in detail. At this point of time, it is suffice to say that in the money market, treasury bills, commercial papers, commercial bills, certificate of deposits, these are the important, instruments of the money market. Where the money is being lent in the treasury bills through commercial papers for 3 months, 2 months, 6 months, these papers are being issued. And when I say papers are being issued, means the lender gives the money for this period of time and borrower takes the money for 3 months, 2 months, 6 months, like that. The participants of money market are RBI, commercial banks, non-banking financial companies, state government, etc. Means these commercial papers, commercial bills, treasury bills are being issued by RBI, commercial banks, non-banking financial companies, state governments, right? And the people who needs money, they borrow money from these banks, banks and the financial companies, right? So the money market participants, these are the money market participants. Suppose a bank needs money, even a bank needs money, so it can take money from the RBI for a short span of time. Through the money market that a commercial bank borrows money from the RBI. A non-banking finance money company needs money. Even banks exchange money with each other. If one bank needs money and another commercial banks lend money. So it is through money market instruments that one commercial bank lends to the other commercial banks. Or put it this way, one commercial bank borrows from the other commercial bank, right? So these are the participants of the money market. The main aim of money market is to raise short-term funds for meeting short-term requirements or for fulfilling temporary shortage of cash, right? I have already explained it. So let me take an example. Suppose I am a businessman. I have to make payment after to my creditor. Say I have to pay 5 crore rupees, and in my bank, including my bank overdraft limit, I can arrange for only 4 crore rupees. So where from this 1 crore income, I'll take help of these money market instruments. I'll borrow from the bank through these financial institution. When I use the word I means the companies borrow the money through these commercial instruments, right? And for 3 months, 3 days, 4 days, they can fulfill their requirement. And as and when they are able to arrange the money, they pay it back. So for a very short period of time, it may be 6 months also, it may be up to a year, right? So these instruments helps in providing temporary shortage of cash. It provides trends in liquidity, interest rate and risk of investors. I have already explained. So the other important component of the financial market is capital market. I said there are two components important: money market and capital market. The basic difference between money market and the capital market is that in the money market, short-term money is being dealt. Means money is exchanged for a short period of time, which is normally, we call it in common parlance, less than a year. Capital market, long-term money, means where you invest money for a long period of time, or you borrow money, you take money for a long period of time. So a capital market is a market that allows the trading of long-term instruments such as shares, debentures, or we can also call it bonds, debt instruments, bonds, ETFs, etc. Right? So, whenever the word capital market comes in our mind, the very first thing that comes in our mind is stock exchanges. We have two important stock exchanges in this country, the Bombay Stock Exchange and National Stock Exchange. What are these two stock exchanges? What is the basic function? They trade. They trade the shares, debts, instruments, ETFs, right? Debentures. So they helps in price discovery. They helps in exchange of sellers and the buyers. They helps in exchanging of shares, and they help in meeting of the buyers and sellers. Suppose I want to buy the share of a company. How I will find the seller? Through stock exchanges I will find the seller, right? So I want to sell the share. How will I find who is the buyer? So through stock exchanges I buy the shares. So these capital markets helps in the long-term money, helps in exchanging the long-term money. So it deals in medium and long-term securities. What these long-term securities are, we have already explained: equity shares, bonds, debentures, ETFs, like that. So it plays a vital role in channelizing funds from savers to borrowers and facilitating long-term investment in the company. See, in the capital market also, you might have heard there are two types of market. One is called primary market, other is called secondary market. In the primary market, when the company raises the money for the first time, fresh money is being raised. That is called primary market. Like you must have heard IPO, initial public offer, offer for sale, follow-on public offer. What does a company do in the IPOs, initial public offer? When the company is being established, and when I use the word company means I am talking of the public limited company. A public limited company which has established its business over a period of time, it has formed the business, it has been running the business. Now it needs money. It needs 500 crore, it needs 5,000 crore, it needs 20,000 crore rupees. What it does, it issues fresh shares to the public. And this is what the primary market means. This is what we mean by IPOs, initial public offer. That is, for the primarily means first time when the company issues the shares to the general public. When I use the word general public, it means not only public, financial institutions, mutual fund houses, right? Means there are various type of investors. There are individuals, retail individuals, there are high net worth of individuals, there are domestic institutions, there are foreign institutions. These are the various types of investors who invest in these capital market. So in the primary market, when fresh money is being raised by the companies, right, that is called the primary market. So these stock exchanges helps in raising the money through the primary market. When I talk of the secondary market, in the secondary market, already issued instruments, it may be shares, it may be bonds, right? Already issued instruments are being purchased and sold. Like in the Bombay Stock Exchange, which is the oldest stock exchange of this country, it was established way back in 1875, right? So in the Bombay Stock Exchange or in the National Stock Exchange, basically the shares, debentures, the bonds are being purchased and sold, right? So this is an example of secondary market. So capital market provides a platform for companies, governments and other entities to raise long-term capital by issuing stocks, bonds and other securities. Right? Now, the other important components. So we have talked about financial institutions, we have talked about financial markets, and third important component of the financial system is financial instruments or assets. When I was talking of financial markets, time and again I use the term shares, debentures, bonds, ETFs. I mean, what are these? these are nothing but financial instruments, financial assets. So financial instruments are monetary contracts between two parties, or I will say simply between parties. The products which are traded in a financial market are financial assets, securities and other type of financial instruments. Financial instruments can be real or virtual. I will be talking of this real or virtual, means just to give you an example, like bonds, shares, these are real instruments, financial instruments. Derivatives which derives its value from these real instruments, they are called virtual instruments. So financial instruments can be real or virtual documents representing a legal agreement involving any kind of monetary value, right? So these bonds, shares, these are legal obligations, these are legal agreements. When a company issues a share, it is a legal agreement between the company and the buyer, means the shareholder, that the company has issued this much worth of capital to the investors, that is shareholders. When a company issues the bond, it is an agreement between the company and the investor who has invested in the bond, that this much sum of money the company owes to pay after a period of time with interest. So these financial assets represents a claim on the income generated real assets of an investee. Like investee can be company. Company has issued bonds worth 100 crore rupees. So different bond holders who were being issued bonds, company owe an obligation to these bond holders that from this 100 crore rupees, the company purchases machinery, company installs the plant, company runs the business, and the income that is being generated by these assets, a part of income will be shared in form of interest with the investors, right? So financial assets represents a claim, that is if I am a bond holder, I have a claim over the income that is being generated by the company. Here in this case, the company is an investee, right? Not the whole income that is being generated, the part of the income which the company has promised to pay me. If company has promised to pay me 8% interest, right? So the company owe the obligation to pay 8% interest on my bonds, right? So the income that is being generated by the company, out of this income, the 8% belongs to myself, to the extent of the amount I have invested in the company as a bond. So this claim is represented by some sort of legal presentation. It gives the holder a legal right to receive expected future benefits as per the given terms and condition. Suppose, just now I had given you example of bond. Even I can invest, one of the financial instrument is shares, equity shares. If I have purchased equity share, I have purchased a small capital of the company. I have purchased small ownership of the company, right? So whatever the income that is being generated by the company, I become owner of that income to the extent I have invested the money, right? Suppose out of 100 crore rupees worth of shares that is being issued by the company, and company has issued say 10 crore shares of rupees 10 each, right? If I have bought 100 shares, if I have invested 1000 rupees, it means out of the total income, to that extent of to that proportion of the 1000 rupees out of the total income, I have a right over the income that is being generated by the company, because I am an equity shareholder, because I am a shareholder who has invested in the capital of the company, ownership capital of the company. So to that extent, I become the owner. So it means that I have a legal right to claim the income on that income that is being generated by the company. So different type of instruments are traded in various markets. The financial instruments can be classified broadly as a primary or direct instruments. A financial instrument whose price is based only on its market value is known as private instruments. When I say market value, like shares, each day the shares are being dealt in the stock market. So it is through price discovery mechanism the value of the share is being discovered. So it includes cash traded products like stocks, bonds, currencies, spot commodities, right? So these are called primary or direct instruments. Understanding primary instruments provide the base knowledge for derivatives, right? So derivatives is not the primary instruments. I said there are certain instruments which are of real nature, which you can see, which you can not see, I will say, but which is of real nature. But there are certain instruments, the value of which is derived on the base of certain underlying assets. If stock is an asset, if the share of a particular X company is an asset, then if in the derivative market, futures, options are being dealt in the shares of that company, right, it is a derivative market. So the derivative markets derive its value on the base of basic primary underlying assets. So secondary or indirect instruments, they are the financial claims issued by the financial institutions against themselves to raise funds from the public. These assets are obligation of financial institutions, bank deposits, insurance policies, etc. Financial instruments can also be classified as equity-based and debt-based financial instruments. When I say equity shares, means ownership right. When I say debt instruments, it means bonds, fixed deposits, right? Debentures, bonds, debentures, they are used interchangeably. On debt-based financial instruments, a fixed obligation is there. On equity-based instruments like equity shares, there is no fixed obligation. If the company earns the money, a company makes the profit, this profit, the value of the share will go up, the company will distribute this profit in form of dividend, right? But if company doesn't earn the income, say for a period of time, company is not under fixed obligation to pay dividend to the shareholders, because each shareholder is the owner in himself or herself, right? If the company is not making profit, company is not an obligation to pay dividend to the shareholders. So equity-based financial instruments represents ownership of an asset. Each equity shareholder becomes the owner of the company. Stocks and shares, where debt-based financial instruments represent amount of capital raised by the company, that is on a debt, a fixed obligation is there, a fixed rate of interest is being paid, and there is a fixed maturity period. That supposing a bond is being issued for 10 years, it means after 10 years, at the end of the expiry of the 10 years, the company is under obligation to pay to the bondholders the principal amount and the interest accrued thereon. The other important, after talking of these financial assets or financial instruments, now the other component is financial services. We have talked about financial markets, we have talked about financial instruments. Now we are talking of the financial services. Financial services are the services which are offered by the financial companies. These services are provided financial intermediaries in bridging the gap between savers and investors of the fund. They help in trading securities, lending and investing, making and allowing trade settlements, and managing the risk exposure of the financial risks. See, within the financial system, there are various intermediaries which helps in where the job of these financial intermediaries is to provide services to the borrowers, to the lenders. You might have heard the term credit rating agencies, venture capital financing, merchant banking, depository services, book building, leasing, factoring. These are all various agencies, the various services, that is the part and the parcel of financial services. I would say not parts and parcel, these are the financial services rather. Just to start one or two, credit rating. I will be talking in my next lecture on these financial services because of the time constraints. I am talking here like say credit rating. In India, you must have heard the word ICRA, CRISIL, CARE, or internationally you must have heard the Fitch. What does the Fitch do? What does this Moody's do? They provide credit rating to the different instruments. Say for example, if a company wants to issue 10,000 crores by issue of the bonds, they want to issue debentures for 10,000 crore rupees. How do common investor know what is the credit worthiness of the company? What is the credit worthiness of this instrument? So they rate these instruments, AAA, AA, A, B plus, B. On the basis of that, there are various parameters on the basis of which they rate these companies, they rate these instruments. What is the paying capacity of the company? What is the track record of the company? Whether the company is earning enough profit to serve its debt instruments. I am saying the company is trying to raise 1,000 crore, 10,000 crore rupees by way of debt instruments, by way of debt. Whether the company is in a position to serve this debt interest burden, right? If not today, after 5 years, 10 years, suppose it is a new company, right? After 5 years, the company will able to serve the interest obligations, right? So not only equity, not only bonds, even in the equity market, the companies are being rated. And internationally, not only in India, but internationally, these rating agencies rates various companies, various institutions, even countries. Countries, what is the credit worthiness of the company? That is also being rated. Each country is being rated by these international credit rating agencies. That if your rating is very high, you can borrow the money at a low rate of interest because the risk involved is low. If your credit worthiness is low, it means the lenders, the risk is high, so lenders will pay you money at a higher rate of interest. So there are a whole host of financial services. I'll be talking about these financial services in my next lecture, right, in detail. So today we have talked about some of the components of the financial systems, right? Basically we have talked about financial markets, financial systems, financial assets, the financial services we have started with, right? So this is basically, there are various components of the financial system that makes the financial system. Then these are the introductory lectures on the financial system, and once again I am reminding you that these terms which I am using, I'll be talking of these terms in detail in my lectures to be followed while talking about the financial markets and system. For today, thank you very much.